In this video, I'm going to show you proof that yield farming has been around since the 19th century and is actually a cheat code if you have it as a part of your investment portfolio. In this video, we're going to compare how yield farming and market making are the same thing and why you should be yield farming right now, because for the first time in history, everyday people like you and I can actually be market makers within crypto. And the cool thing is these major banks and financial institutions who've been doing it since the 19th century, they aren't legally allowed to market make within crypto. So those good yields are reserved for everyday people like you and I. So we're going to cover the concept of market making, why it's profitable. We're going to cover some of the largest players. This is going to be all things market making and yield farming. And after watching this video, I guarantee you that you're going to look at market making and yield farming in a completely different light. So per usual, none of this content is financial advice. It's for your education purposes only. Do your own research. And without further ado, let's get into the content. So to start, what the hell is market making? Well, it's exactly what it sounds like, actually. You're making a market. Have you guys ever wondered how the assets and the liquidity are available to you when you go on your favorite exchanges to buy your stocks, like Fidelity or Webull or Robinhood? It's not Robinhood that holds the stock. Let's say you're going to buy some Tesla. It's not Robinhood that's holding the Tesla in the cash. They may hold some of it, but the bulk of it is coming from market makers, companies like Credit Suisse, Deutsche Bank, Goldman Sachs, Morgan Stanley, etc., who are saying, hey, here's $500 million in Tesla, here's $500 million in cash. Only use my liquidity when the price is between X and Y, and they profit off of something called the bid to ask spread, which we're going to go through here. Essentially, you can look at it as selling shovels during the gold rush. The people who are selling shovels a lot of the times made way more money than the people who were mining gold. So it says here, what is a market maker? Market makers are essential players in the trading world, providing liquidity and ensuring that buyers and sellers can execute trades efficiently. They are typically banks or specialized firms that operate as market participants, providing liquidity and buying and selling securities at the market price. The history of market making dates back to the earliest 19th century, when brokers would gather in coffee houses to trade security. Over time, market making evolved into a more formalized process with specialized firms dedicated to providing liquidity. Today, market makers work to provide liquidity in a variety of financial markets, including stocks, bonds, and derivatives. Market makers use various strategies and techniques to provide liquidity, including quoting bid-to-ask spreads, managing inventory levels, and using algorithms to automate trading decisions. All right, guys, so now that we know what market making is, let's talk about, is this profitable? Like, should you be doing this? Why the hell are market makers doing this? I'll tell you one thing. Financial institutions are in the business to make finances, to make money. They're not just market making for their own goodwill. If it wasn't profitable, they wouldn't have been doing it for so long. Every time you go and you buy a stock or any kind of security and you look at those trading fees, just know that most of those trading fees are actually going to the market maker and not the actual broker. The broker is just the middleman between the person who's buying and the market maker who's providing the liquidity. And I'm gonna be honest with you, we always talk about impermanent loss. I made a video on how you can turn impermanent loss to your best friend, as there are strategies that the more impermanent loss you experience, the more successful and the more money you make. Market makers experience impermanent loss too. The risks are exactly the same. Let's dive into some of it here. So it says market makers are required to provide liquidity to the market, which means that they must be willing to buy and sell securities at all times. This can be a risky business, as market makers must be prepared to take on large positions in securities that may not be in high demand. They earn a profit by maintaining an orderly market and earning money from the bid to ask spread. So guys, just so you know, if it wasn't for market makers, we wouldn't be able to invest, just so you know. It says here, the New York Stock Exchange, for example, has a number of market makers for each stock, ensuring that there will always be a buyer or seller available. To make a market, the market maker will purchase securities at a lower price than they sell them for, earning a profit on each transaction. This is known as spread trading and is one of the key strategies used by market makers to manage risk and maintain profitability. It says here, during times of high volatility, for example, market makers may be less willing to take on risk, leading to a wider bid to ask spread and less liquidity. Conversely, during times of low volatility, market makers may be way more willing to take on risk, leading to tighter bid to ask spreads and more liquidity. So it says here, market makers profit off of the difference between the highest price a buyer is willing to pay for a security, the bid, and the lowest price a seller is willing to accept, the ask. And this is the bid to ask spread. Market makers buy securities at a lower ask price and sell them at the higher bid price, pocketing the difference as profit. The price is always changing, so market makers must be ready to adjust their prices accordingly. In addition to earning profits from bid to ask spreads, market makers also charge fees for their services. These fees can include transaction fees and rebates for providing liquidity. However, market makers must balance these fees with competition from other market makers who may offer lower rates. I'm going to show you guys here in a bit how these exact same things are at play today. To maintain profitability, market makers use various strategies such as offering faster execution times or better prices than competitors. This is an article written on the Cornell University website, cornell.edu. So it says here, market making firms are incredibly profitable. According to the Quartz article below, Citadel Securities and Virtue Financial, two market making firms that control roughly 22% of all U.S. equities trading volumes, generated over $10 billion in net trading revenue and completed more transactions than the New York Stock Exchange. And here's another key point right here that I want to speak on later as well. The more illiquid the security, the more market-making firms profit as their bid to ask spreads are wider. This is basically due to slippage. Okay, so now that we know what market making is in the traditional sense, let's talk about how it's the same, maybe a little different within crypto. So in crypto, you have what's called decentralized exchanges that are permissionless. In order to be a market maker in the traditional financial world, you have to, I assume, get permission. I don't know exactly what the process like, but I know if more people can do it, they would. I'm sure that there's some red tape and some hurdles you have to jump over in order to do it. There's probably a minimum required of investment, of liquidity that you have to hold for a certain set time. But in crypto, none of that matters. You can go on Uniswap and provide liquidity for $5 in ETH, $5 in USDC. And you can also determine the price you want to provide your liquidity in. For example, let's say you think the price of ETH is going to trade between $2,000 to $3,000. You can make that your range. When you go out of range, you're in 100% USDC. When you go out of range to the upside, when you go out of range to the downside, you're in 100% ETH. And this is called impermanent loss. It's permissionless. You can get in and out whenever you want. There is no cap on how much liquidity you can provide, and you can do whatever pair that you want at any time. So let's look at some of my yield firming data. I'm going to compare and contrast them with traditional market making and why it's actually better in Web3. So if I go to Uniswap and you click top pools, you can see these are all market making positions. You see their pairs, and I always tell our students and the people on this channel, look for pairs with high volume to TVL ratios, right? So this USDC ETH pair is pretty good because you have $1 billion in 7-day volume, but the TVL is only 175 million, right? Now, in traditional market making, I've mentioned that, it's competitive. In order to make more money, they'll lower their fees or offer faster executions. You kind of have a similar thing at play here. You see you have an ETH USDC pool here at 0.5%. You also have one at 0.3%. Now, you think that the TVL will be higher here because it's 0.3, but it's not. So not only are you making money from the trading fees when people go in and out, but you make a 0.5% on each transaction, no matter what it is. And these are the fees you make no matter what they are. There are 1% pools as well. Now, we talked about this. The more illiquid the security, the more market making firms profit as their bid to ask spreads are wider. Let me show you an example of this. All right, so guys, I made a video on how I plan on turning $15,000 into $1 million by investing into maplefinance, and I also showed my yield farming strategy in there as well. And in there, I talked about how this Maple ETH pool is really just a gem of a pool. The reason why is because the TVL is fairly low, but the volume isn't that far off. But given that the TVL is low, that means the liquidity is low. That means the slippage is high. You're already getting a 1% fee on each transaction. But let me show you exactly what I mean by the slippage being high. Let's say I want to trade 2 ETH for some Maple. Now remember, the TVL in this pool is really, really low. Look at that. It's a 3.03% slippage rate because of the low liquidity. Now, this sucks if I'm a trader, but as a liquidity provider, that fee goes to me. And it's good to find pools like this because Maple is a gem of a coin. We've made plenty of videos on Maple. Well, 2 to be exact. And once people find out how good it is, eventually they're going to rush to buy it. But people are going to be buying faster than liquidity providers are going to provide. So the few people that are in this pool with the correct range, like an intelligent range, are going to be making a lot of money because it's a few people getting a large percentage of the pie. and the volume is going to exceed the TVL by many multiples. I guarantee it. And it's going to offer a chance for you to make APYs in the triple to quadruple digit range. If we look at the pool now, you can see all of the data here on Revert Finance. Right now I'm getting 99% APR, so basically 100% APR. I've been in this pool with, I got in there with like 12K or something, but ETH and Maple have both gone up since that happened. I've been in this pool for just a day below 2 weeks, and you can see that I've made $486, and my range is pretty wide. Like, you can see where most people have their ranges. Mine is a little bit on the outside because I want to give it room to run, and it's just a strategy that I'm deploying. Like, guys, yield farming is a great tool to have on your investment tool belt. I can't say that enough. So now let's talk about how yield farming should fit within your portfolio, how it should intelligently fit inside of your investment portfolio. I made a video on how to think like a pro yield farmer, and I covered this topic in depth. But just to sum it up, basically, if you look at market makers, these banks, they don't only do market making. And it's a reason for that. They have cash on their balance sheet. They have other assets, real estate, stocks, bonds, etc. And then they do market making because it's a cash flow portion. You need currency stability. You need speculation in assets, and you need cash flows so you can increase your cash position as well as increase your asset position so that you can add more to your cash flow position and you cycle it. This is why I talk about yield farming and trading mixed together is the best way to maximize your profits if you know what you're doing. So you always hear about the standard crypto portfolio, 30% BTC, 30% ETH, 20% cash, and then 20% altcoins, maybe 15% altcoins, and 5% high risk. I would go as far to say, and this is how I have my institutional portfolio set up for me and my investors, percentage in BTC, percentage in ETH, a percentage in cash, percentage for alts, percentage for high risk alts, small percentage, no more than 3 to 5%. But I have 20% of my portfolio set aside just for yield farming. And I've been yield farming for a little over 2 years now. And I'm to the point now where the gains that I've made has increased the 20% from what I started off with. So I'm literally yield farming with house money. So I gave an example in that Maple video. If I'm getting 100% APY for 6 months and I'm in a $12,000 position for easy math, that means I will accumulate $6,000. I can take the ETH to buy Maple, and now I have my take profit strategy set up to where I just accumulated $6,000 in Maple Finance for free for market making. Now I can turn that $6,000 into 3 to 450K, depending on how the price goes within my take profit strategy. And that's money I wouldn't have had any other way. I could have just held Maple and turned the 15K I have into $1 million, but why not accumulate 6 grand more and I can make 1.4 million, 1.5 million. Now I can sell some of that for cash where I can use to wait to pounce on another opportunity as I see fit, put some more into altcoins, put some more into my yield farming. So now that 20% of the portfolio is a higher balance. And then as I'm getting more rewards, it's going to represent more rewards for me to go and make more money. And it's literally just a compounding snowball. If you know what you're doing, guys, it's the best way to make money in crypto. And when it comes to yield farming, there are strategies you can deploy in bull markets, in bear markets, and in sideways markets. And if you're interested in learning how to conduct your portfolio like a professional market maker, like a professional institutions always outperform retail investors. And it's not just because they have more money. The fact that they have more money makes it harder because it puts a target on their back and it makes it harder for them to move in and out of positions. Like, imagine if they were going to go and try to trade Maple and they got millions of dollars. They wouldn't be able to. The slippage would be too high. It's not even enough in that pool. So it's actually harder for them to get returns. Yeah, they have analysts. Yeah, they have experience and teams and, relationships with brokers. But there's no reason why you can't outperform them with less money if you think like them and if you know what you're doing. So guys, if you're interested in that, we have our flagship Know It All Academy course that covers everything you need to know to be a successful trader, yield farmer, investor, how to structure your portfolio, how to generate passive income, how to find pools, how to know when to exit, how to track it, conduct fundamental analysis, know how to conduct chart mastery so that you can open up a chart and know what you're looking at, and more importantly, master your entries and your exits. After you go through the course, you get access to our professional coaches who do this for a living, including myself. We hop on live calls with you and we are invested into your success as an investor. If that sounds interesting to you, click the link in the description or visit knowitals.xyz. book a free strategy session, talk to one of our team members. Ultimately, we'll try to help you, meet you where you're at, but the goal is to see if our program is a good fit for you. If it's not, we're happy to point you in the right direction and, like I said, answer any questions you may have. But with that, I hope you got value from this video. I conclude here. If you did get value, I ask that you consider subscribing. Drop a like, drop a comment. Let me know what you want me to cover next. If I was wrong, if something was confusing and I didn't explain it as well as I could, I'm here to help you guys out. So with that, I thank you guys so much for tuning in. I love every single one of you watching, and I'll see you guys in the next video. Take care and trade safe. Peace out.